So now we are delighted to welcome the Treasurer of the Royal Society of New South Wales to set us right on finance. And indeed, that is what he has done with great flair in many of our council meetings. He can see through a spreadsheet to the problem in a second. Indeed, it's he who pointed out that we are crucially dependent on fellowship and membership. We've been lucky to have him, and even luckier that he has found time to talk about his passion tonight to us. Digital finance is perhaps not everyone's passion. It's an unusual passion, but it's a very important one. Peter's a practitioner and an academic. He worked for a large accounting firm in the finance sector in Australia and New Zealand. He's a member of the Institute of Chartered Accountants, fellow of the New Zealand Institute, and was on the New South Wales Regional Council for 6 years and chair for a year. He's taught at graduate and undergraduate levels at UTS in areas of financial reporting regulation and financial statement analysis. His research is primarily in the area of financial reporting regulation, although he's also worked on earnings management and corporate governance and intangible assets. He's particular, so he's prepared reports on digital financial reporting for Chartered Accountants Australia and New Zealand and made submissions to parliamentary committees on that. And so that is what we're about to hear. So thank you very much, Peter, and welcome.
Hi, my name is Peter Wells, and my background is that I finished up as an accounting academic, but I started off life as an auditor. Then moved on to being as an analyst, and I then finished up in academia, and I spent a lifetime in teaching and researching in financial reporting. And I would probably rate myself as being a fairly efficient user of financial reports, or as one of my colleagues once said, you're probably slightly better than average, but I think I'm probably better than most at actually reading financial reports and trying to make sense of them. However, that's increasingly difficult because financial reporting practices these days tend to be rooted in practices from the 19th and 20th centuries. So what I want to be talking about today is what's necessary to bring financial reporting into the 21st century. Hi, tonight I want to talk about what is necessary to bring financial reporting into the 21st century. If we think about financial reporting, and I still call it financial reporting, it's essentially a communication process between management and the various parties that are interested in the activities of the modern corporation. These would include investors who are making decisions about buying and selling shares, lenders who are making decisions about whether they advance funding to a corporation for investment or for operating purposes, creditors who can sometimes have very large exposures to the companies that they deal with, employees, because employees' good fortune is tied to that of the corporations that they work for. There's not much hope for longevity of tenure or pay rises for corporations which aren't performing well. And to that extent, I would probably be very concerned if I was an employee of companies like Star Casino at the moment, which is facing a lot of distress. And there have to be concerns about the extent to which their employees have A, longevity of tenure, and B, whether there is any scope for pay rises in the future for them. Regulators who oversee financial reporting, regulators who oversee the activity or behavior of corporations, and government who has to somehow manage the economy, where the largest players in that economy are the corporations who do financial reporting, and financial reports are a window on the activities of the firm. Now, I always call it financial reporting, and that's probably a financial legacy, because originally corporate reporting was primarily focused around financial reports. But these days, corporate reporting is much broader, and it now includes a raft of other things. Increasingly, it's including climate and sustainability reporting. And there are other aspects of reporting which firms are required to undertake, such as compliance with the Modern Slavery Act, and there are a raft of other requirements that firms are required to report under. So whilst I'll typically call it financial reporting, I'm probably describing an activity which is probably better described as corporate reporting more generally. To give you an idea as to why we have a problem in this area, it's probably fairly appropriate just to look at how corporate reporting or financial reporting has changed over the last half century. If I could pick on ANZ Bank, and I could pick on any corporation, they're just unfortunate. If you go back to 1984, an auspicious year for some people, 1984, but if you looked at their annual report in 1984, it was 59 pages in total, and there were 22 pages devoted to the financial report. Financial reports back in those days were much simpler, much shorter, but that was really a reflection of the environment in which we operated. Businesses were much simpler, their activities were much simpler, and you've only got to look at the financial instruments which financial institutions use today to appreciate that, well, most of these actually didn't exist or hadn't been traded in Australia back in 1984. So financial reporting was, generally speaking, much simpler. It wasn't such a challenge, and we had documents which could be probably read by someone who had even a modest understanding of accounting. If we turn the clock forward to 2024, and I've chosen last year because the three of the big four banks haven't reported for 2025 yet. If you look at the ANZ financial report, you'll see that it's grown from 59 pages up to 228 pages. The financial report part of it has grown from 22 pages to 127 pages. And if I was going to characterize the financial report, I'd say that it was a very dense and very difficult to understand document. And that's not a criticism of ANZ Bank and their accountants who prepare the report. It's not a criticism of the standard setters who have developed a regulation which requires reports like this now. Rather, it's a criticism of, or a commentary, I should say, rather than a criticism of the environment in which these firms operate and the activities of these firms. Now, I've been quite unfair there. I've picked on ANZ Bank, but I could equally well pick on Westpac. And what would you find different in 2024? You'd find a financial report that was 304 pages, and 138 pages of those were developed to the financial report, the financial statements and the notes. What about NAB? Are they any better? 292 pages, of which 127 are devoted to the financial report. And finally, 2024 for the Commonwealth Bank, 334 pages and the annual report, and 154 devoted to the financial report. Now, I think it's pretty obvious that when you have financial reports of this length, and when you have financial reports which have the level of complexity to them, then it's going to be very, very challenging for any individual to be able to read and understand what they're doing. So you'd have to say a fundamental question is the communication process being effective? Is it occurring well? Is that getting better or worse? Well, probably a good indicator here is that one of the innovations that we're having in corporate reporting is that we're increasingly including climate and sustainability reporting. One of the things you'll see there is that CommBank has issued their 2025 annual report, and you'll see that this year their financial report, or sorry, their annual report has jumped to 453 pages. So we're halfway to War and Peace. And the biggest single determinant of that change is the inclusion of increased sustainability reporting. So the point I'd make here is that financial reporting is at a crisis point. The volume of information, the complexity of the information means that it's highly doubtful that an individual is able to read and understand the contents of such complex reports these days. And that has to start up making you ask the question, are financial reports still fit for purpose? And in this respect, I sort of like the comment or the quote from George Bernard Shaw. The biggest single problem in communication is the illusion that it has taken place. In relation to corporate reporting these days, I think that's a very, very apt or appropriate quote to put up at this point in time. The complexity, the detail of corporate reports these days means that a human being is probably going to be incapable of understanding the content, certainly not the ordinary person, maybe a few specialized accountants out there. And if that's the case, you've got to ask yourself the question of whether corporate reports are fulfilling their purpose of being a communication device. If you can't understand them, the answer has to be no. And that's a pretty tragic situation that we find ourselves in. We have a problem. Is there a solution? Undoubtedly, the solution has already been identified, and that is digital financial reporting. It's not a new concept. The American Institute of Certified Practicing Accountants set up an initiative in 1999, last century, to address the problems of complex financial reports, which people couldn't understand. And they came up with the idea that we'd have this digital financial reporting process. This initiative is funded by AICPA, the Institute of Certified Practicing Accountants, and its supporters were firms that we all know about, or businesses we all know about. The largest accounting firms, PwC, EY, Deloitte, KPMG, and of course the antecedents of those firms in 1999. They all supported this initiative, and they all came to the conclusion that digital financial reporting was the future. It was also supported by the largest technology firms, most obviously Microsoft. All of these firms realized that traditional financial reports were no longer fit for purpose. We needed to replace it with something, and that something was digital financial reporting. So what is digital financial reporting? Digital financial reporting is a system whereby we include in financial reports a system of identifiers which allow computers to extract information from financial reports. It does this through a system of identifiers which are called tags or labels. And this is attached to information in the reports. It can be attached to numerical values, or it can be attached to text. And the system of labels which are used is called a taxonomy. And there are two taxonomies which have been developed around the world over the last 20 years. The first one was the Financial Accounting Standards Board taxonomy, the FASB taxonomy. And this was based upon accounting standards developed by the Financial Accounting Standards Board for application in the United States. Quite obviously, the FASB is going to identify tags which identify disclosures or items which are required by US accounting standards issued by the Financial Accounting Standards Board. The other major taxonomy is the IFRS taxonomy. This was developed by the International Financial Reporting Standards Board. And this taxonomy is aligned to international accounting standards. So there is an alignment between the taxonomy and the disclosures that are required by international accounting standards. And these are the same standards that are required to be applied by corporations to financial reports in Australia. So there are two taxonomies. Is there one taxonomy which is most obvious for Australia? The IFRS taxonomy. I think the thing which we should highlight here and now is that if we're going to go down the digital financial reporting route, we're not dealing with new technology. We're dealing with well-established, used, and working technology. We're not at the bleeding edge. So the first thing you need for digital financial reporting is that you need a taxonomy, which indicates the labels that you attach to data, and you then need a technology to attach those labels. The first version of that technology was referred to as XBRL, and XBRL was a bit complicated, and it required the preparation of two documents in different formats. But this was addressed with the second generation, which is inline XBRL, which now says that you can have digital financial reporting with one document. The tags are not visible to human beings reading a financial report, but the tags are visible to computers that read the report. Probably the best way of thinking of XBRL and digital financial reporting and the taxonomy for people who have no background in accounting is to say, well, it's a bit like attaching number plates to cars and trucks. When you attach the number plate, you can tell exactly what vehicle it's attached to, what the type of vehicle is, and you can tell who owns the vehicle, all those sorts of information. So the tags might be described a little bit as being like number plates. Very structured number plates with clear rules in terms of how they're determined and how they should be interpreted. Is there much international experience with digital financial reporting? As you'd doubtless guess, given that the American Institute of Certified Accountants probably initiated the process of digital financial reporting in 1999, it's not a surprise that the US was amongst the first to implement it. And from 2005, so within 6 years, US firms who were SEC registrants were allowed to voluntarily lodge digital financial reporting documentation onto the EDGAR database. The EDGAR database is, well, the first three letters are electronic data gathering, and it's a database where all companies lodge their returns, and this is a database which is searchable by anybody, and you can go onto the SEC website and see it for yourself. So from 2005, it was voluntary. By 2009, it was mandatory for all SEC registered firms for all SEC filings. So what we can see is that they very quickly went from an adoption period to a mandatory period. And during this implementation stage, they learned some important lessons which we can learn about in Australia. So early on, a lot of firms thought they were special and they used extension tags. And extensions were used too commonly. This undermined the usability of the data. So by about 2010, the SEC came out with a mandate: don't use extension tags unless they're absolutely necessary. So we have learned through the process, and it's probably fair to say that what we're looking now is at a technology which is well developed. A really important question is, did it change the use of financial report or information that was lodged with the Securities Exchange Committee? Was it something which had a real impact, or was it something just made us feel good? Was it a fad? And relatively early on in the piece, the Securities Exchange Commission did release some data on the use of the EDGAR database and the use of the database in terms of accessing information and details of how that information was accessed. What was interesting is that over a 5-year period, they identified EDGAR as being accessed 2.3 billion times. Not million, billion. Of those accesses, 2.1 billion were done by what would be best described as robots. Firms going in there, vacuuming the database, getting the information out and putting it into their usable format. So this wasn't a fad. This was a fundamental change in the way in which people accessed corporate and financial information. No longer was it individuals accessing the information, it was computers, and they were screening it and formatting it how the users wanted it. It was a real change. Is the US alone? No. A lot of countries followed in quick succession. Korea, Singapore, UK, European Union. Actually, probably it's easier not to say which countries have adopted it, but to say the largest or the most relevant countries to us which haven't adopted. Those who haven't adopted digital financial reporting are Australia, New Zealand, and Canada. That's a very exclusive club, and it's probably not, as Groucho Marx said, it's not a club that I'd want to be a member of if it would have me in it. What we can tell you is that 90% of the world's stock markets by market capitalization now require digital financial reporting. Is this important? Well, if you think of yourself as an international investor and you're searching for information on companies to invest in, if you have difficulty accessing the information, is it going to come on your radar as a potential investment? No. So by not having it, we run the risk of losing visibility to international investors, falling off the radar, and the complications of that would be a rise in the cost of capital at the end of the day. So it's a very good economic reason why 90% of the world's capital markets now use digital financial reporting. What are the benefits of digital financial reporting? One of the things that I find quite interesting is to compare the benefits of digital financial reporting, which were claimed at the outset, and contrast these with what academic research has verified subsequent. At the outset, it was claimed that digital financial reports, because the information was totally accessible, would increase the speed, accuracy, and usability of financial information. That seems like a pretty much no-brainer. It would make information easier for investors to analyze, to put it into the format that they want. It would assist in regulatory filings, such as with the SEC on their regular database. It would facilitate business information processing. It would reduce the cost of using financial reports for users. What most people don't realize is that our major financial institutions, when they get a financial report, will send it off to the Philippines. They'll extract the information manually out of the financial report, and they'll put it into a spreadsheet, and the data will then be sent back to Australia for use. It's a very slow and convoluted process. It's expensive, and it's also inaccurate, because whenever you get this done, the first thing you always do is to make sure your balance sheet balances. That's not a trivial question. So please just appreciate cost reduction is a significant issue. Through the facilitation of more comprehensive analysis of financial reports, it's going to allow regulators to more carefully review and target financial reports for firms for further analysis or questioning. One of the things that's always horrified me is that 48% of firms in Australia over a number of years exhibited indicators of impairment, but did not recognize an asset impairment. Now, that's a challenge for me, because it says one of two things. Either A, they're not complying with the accounting standard and not recognizing an asset impairment where they possibly should be. Or B, if they do believe that an asset impairment is not necessary, then the market is obviously uninformed, in which case these firms should be making a continuous disclosure filing. So I think for all firms which had a indicator of impairment, if I was the regulator, I'd be sending out a letter, please explain letter A. Either A, disclose why you haven't recognized an impairment, and or B, make a disclosure consistent with the continuous disclosure regulation. It's one or the other. You can't avoid it. So more targeted regulatory focus on financial reports, easier identification of the impact of regulation. So we had a very significant accounting standard issued a couple of years ago on leases, understanding the implications of that leases standard, and understanding whether it provided relevant information for users is a hot topic. Enhanced enforcement of existing regulation. So I think we can see that those were the sort of all the benefits that were claimed. And what have we seen over the last 15 years as research has started to be done on digital financial reports? And academics aren't always the most creative, and they're very much targeted those claimed benefits at the outset to see if they were delivered. And so far, we've seen that research has established that when digital financial reporting was implemented, there was a increased speed of stock price reactions to any announcement. In other words, the announcement had information, it was more quickly impounded in the stock price, a more efficient capital market. There was reduced information on asymmetry, less uncertainty about what that information meant and what the implications were, less stock price and return volatility, and an increased understandability of the data being provided. In other words, people could screen it, analyze it, and reformat it better. There were fewer errors in financial reports because the preparers and the auditors could run it through programs which would sift out small errors, which are errors nonetheless, and probably the big daddy of them all, and it's probably a consequence of all of the above, that for firms, there is a lower cost of capital, and that is a real economic impact. What goes along with the cost of equity capital is a lower cost of debt capital as well. What's not surprising is that there was, with digital financial reporting, there was an increased visibility for small companies because the cost of investigation was reduced. So corporations could focus on, or investors could focus on smaller corporations as well as the big ones. And small investors, well, they didn't have to worry about the cost so much of investigating because the information was in a more usable format. So small investors also benefited. And you'd have to say this is almost a democratization of financial information. However, probably some of the biggest benefits were for the largest corporations who had the most opaque reports, because it allowed users to employ sophisticated tools to analyze the information contained therein. Now, one of the sad things is that a lot of this research actually hasn't appeared in the accounting and the finance literature. Why? If you did one of these papers, and it's one of the reasons why I'd never do one, is the first challenge you're going to have is that you're going to say, the reviewer is going to say, where's the contribution? This is exactly as predicted by the finance literature. You're proving things which have been proved in other areas before. What's new here? Nothing. So the claimed benefits, the delivered benefits, there's almost a perfect alignment. Why? Because it was so obvious right from the outset, and we've proved it's obvious, but you probably have to find it more in the IT journals than in the finance and accounting journals. It's a bit sad, but that tells you something fundamental here. Digital financial reporting was dead obvious even from the outset. with all these benefits, you'd have to say, well, there has to be some downside. And when people have been arguing against digital financial reporting, they've always tended to focus on the cost of digital financial reporting. And this is a really interesting one from my point of view, because it's the contentious part. And if you have a generic financial report, and I call it generic, call it a boilerplate, call it whatever you like. But if you have a generic financial report, and if you look at the financial reports for literally any small company, you could say they all look the same. Then in those circumstances, there is simple software which has been available for years, which can enable XBRL tags to be included. The software is generic these days. It's not expensive. In fact, it's very cheap. And what I would say is that it's probably not much different to what happened before we had digital financial reporting, and where companies like Caseware had software where you'd plug the information in and it would spit out a complying financial report in terms of the disclosures required by law and by the accounting standards. So we're moving from one software package to another. And if you're going to ask me, as being an old accountant, I'd probably say that'd be a bit like switching from Lotus 1-2-3 to Excel. The world did not move or shake. So for small firms who prepare very generic financial reports, the costs are actually quite minimal. There's software which generates these reports really easily, and there's no major expertise which is required. However, when people talk about the costs of digital financial reporting, they always focus on the costs of producing what I would call bespoke, individualized designer financial reports. These bespoke reports are not generated by a simple piece of software. And if you're going to produce one, you'd probably have a labor-intensive process of attaching tags to the information. Although maybe these days you'd increasingly be able to use AI to do so. But for me, there is a bit of a paradox here. One of the arguments against digital financial reporting, or one of the arguments for bespoke financial reports, is that it lets companies, corporations tell their story. It lets them present a narrative upon how they want you to read their financial reports. And this brings me to a bit of a conundrum. And the conundrum is that if we move to digital financial reports, and we have firms having bespoke financial reports with tags in them, are users going to read the bespoke corporate report, or are they simply going to go to the digital data and format it how they want it? And to this extent, it almost seems as though the arguments for a bespoke financial report are actually self-defeating, because if you have a bespoke report, then let's be perfectly honest, nobody's going to read it. So why bother having one? You might as well just go to a generic one. And that's where I think a lot of the arguments against digital financial reporting become actually quite self-defeating arguments which focus on the cost. Now, at this point in time, you're probably going to be asking yourself, well, digital financial reporting, that seems to be a bit of a no-brainer. The rest of the world does it. They've been doing it for nigh on 20 years. What's happened in Australia? Well, I'm afraid that in Australia, we seem to be somewhat stuck in a 19th to 20th century model. In 2009, ASIC, the Australian Securities Investment Commission, they allowed voluntary filings of firms to be done with digital financial reports. What was the uptake of this? In the next 16 years, how many digital financial reports were actually lodged? Zero. Not a single one. So nothing actually happened. What's actually quite interesting is if you look at firms, Australian firms who are US SEC registrants, if you want to get hold of their digital financial report, you always struggle to find it on their corporate website in Australia. But if you want a copy of it, just go to the SEC website and you can download it there. So they've gone to the expense of producing it, but they still make it hard for Australians to actually find it. Yeah. Does the average Australian know to get the digital financial report? Oh, you should go to the US regulator website. To me, that just seems somewhat of a paradox. So we went from 2009, we had voluntary, nothing happened. In 2020, we had a joint parliamentary committee on auditing and financial reporting, and they actually made a very, very strong recommendation that Australia should move quickly and efficiently to digital financial reporting. They recognised it wasn't new technology. They recognised it would increase transparency of financial reporting, and they were quite cognizant of the benefits of digital financial reporting. But what happened? Nothing. It disappeared into Treasury, and nothing has happened in the intervening period. Not even a discussion. Is it going to be different this time? As someone who's been an advocate for digital financial reporting for too many years, what's going to change this time? The Productivity Commission has come out with a recommendation for digital financial reports. It's identifying the productivity improvements which should come from it. This is a major concern for government productivity. And so maybe that is going to give it a bit more impetus or traction inside Treasury and the government to actually do something in this space. Importantly, business. The G100, the group of 100 largest corporations in Australia, have also come out in favour of digital financial reporting. However, there is one thing which I think will be an even bigger catalyst for digital financial reporting, and that is climate reporting. Climate reporting, sustainability reporting, is expanding the volume and complexity of information in financial reports. Everybody now understands that this is an issue. It can't be ignored. Humans cannot read and understand financial reports. We need computers. That requires digital reporting. To the extent that there are strong advocates for climate reporting inside Treasury and inside the government, then that may provide the catalyst for something to happen this time. I'm probably more optimistic now than I have ever been in the future, because I think people are realizing that climate reporting is the straw that breaks the camel's back in terms of corporate reports which are usable and understandable. We need to change our technology. Having said that, there are some critical decisions that have to be made as we implement digital financial reporting. We need to establish priorities. What are our priorities? I would advocate that digital financial reporting, not digital climate reporting, be initiated first. Digital financial reporting has well-established taxonomies. It has well-established software. It's very, very tried and tested technology. The UK Corporations Companies House requires it for all companies. And they even provide software tools to facilitate users being able to use those reports for free. Climate reporting is more immature. So I would argue that Financial reporting should be first cab off the rank. Climate reporting should be second cab off the rank. However, I do think that Treasury will be arguing the other way around and government arguing the other way around. But that to me is a more risky process. So hopefully common sense prevails and we get financial reporting before climate reporting. The next challenge is which companies have to prepare digital financial reports. What most people don't realize is that corporations are required to prepare financial reports in accordance with the Corporations Act. And this is required for certain types of corporations. And the last time I bothered to look, this was just over 22,000 firms. Should all 22,000 firms prepare digital financial reports? There are arguments over cost and benefit, and many people advocate for a much lower level. One of the challenges is if we limit those firms that have to prepare financial reports, is that going to adversely impact users? And is it going to impact how firms record their activities? One of the concerns that I have is that we have a number of different classifications of companies with different reporting requirements. One of the things that I would probably advocate right up front is that the corporations for which this is going to be most problematic are those that have to prepare climate reports. So recognizing that climate reports will also be able to be prepared digitally, I would say we should have the same threshold. All companies preparing climate reports and financial reports should prepare digital versions. So there's only one group of companies and it impacts them all. So I would argue that it's going to be probably around about 7,000 firms out of the 22,000. These will be the largest firms, the ones material, the ones who have the biggest impact on our economy, and the ones who have the biggest impact on our environment. So it's a materiality issue there. The other thing, which is probably quite critical moving forward, is we need to work out how the information is made available to the public. ASIC makes corporate filings available for a fee. That is the total antithesis of digital financial reporting requirements. Digital financial reporting requirements suggest that people need to be able to access the information freely and by computer. That's what happens all around the world. The US, the UK, everywhere. Everywhere around the world makes the corporate information available free and searchable. So when we implement digital financial reporting, Treasury and ASIC need to come up with a repository, a database, which is searchable for free by everybody. Free access is ultimately what is required if we're going to realize the benefits. If you don't have free access, searchable access to corporate filings, then it's a bit like having a grand final with no spectators and no television cameras. Who cares? So that is a critical decision which needs to be made. So those are the three issues where I think there is important decisions to be made, and I seriously believe that it should be financial reporting first, climate reporting second. Any company which is ultimately going to have to prepare a climate report should be locked into digital reporting for both climate and financial, and access must be free and easily searchable by anybody. Otherwise, you will not realize the benefits. I think the important thing to accept, though, is that we just need to make a decision. Once we make the decision, then the technology is there, the people are there, the expertise is there to make it happen quickly and efficiently. The benefits may be delayed a little to the extent that it may require not just 1 year, but maybe 2, 3, 4 years of data before it becomes fully functional and fully operable, fully beneficial. But that's not an argument for deferring the start. It's just saying we should have started 5 years ago, and you won't get an argument with me from that one. So thank you very much. That's my description of digital financial reporting and why I think it's critical for us. To me, it's an absolute no-brainer. It has been for the last decade. And to me, it's an embarrassment that we in Australia haven't actually gone down this path. So thank you very much. And hopefully you learned something about digital financial reporting tonight. Take care.
Peter, before you can see me, thank you so much. It is an extraordinary thing to have a passion about financial reporting. I mean, it isn't, and perhaps that's what's made this so interesting. I loved your use of the George Bernard Shaw quotation that the single biggest problem with communication is the illusion that it's taken place. And there I am. I feel that that is a constant problem with financial reporting. I mean, I was a mathematician as a younger person, but I still find reading ordinary financial reporting quite hard work. You know, you've had a lifetime of it. We know that you can read a spreadsheet so fast. And as we know, if you've got hundreds of pages of it, it's apart from the AICD saying that's not best practice, what you say it's halfway to War and Peace. It's really hard work if you're not familiar with it. Do you think it's going to be better for somebody who isn't informed with in this new regime that you're looking forward to?
Okay, if I could answer your question this way. If you think about digital financial reporting as providing data, and it's a volume of data which I feel comfortable with, but let's be honest here, I'm not normal. What we need to do is and what you find happening, and there are companies in the US that do it, they will extract financial data and they will put it into more user-friendly formats.
Yeah.
In Australia, once upon a time, we used to have this thing called concise financial reports. These were reports which were 10% of the size of the full financial report. They were consistent. And can I just tell you, they were actually readable by human beings, by people who weren't accountants, real people. And that's where I think we need to get back to, because we need to understand that, unfortunately, from my perspective, not everybody is an accountant. And as a communication process, we need to make sure we provide them with information which they can read and understand. Digital financial reporting provides the ability, the scope, to provide reports which are tailored to the level of understanding which the user requires, from financially illiterate to financially expert. And when you get to the financial expert category, it also would encompass users who fundamentally disagree with some of the accounting standards. So, for example, one of the things I've never agreed with is equity accounting. So the first thing I do when I use a set of financial statements is I reverse out the effects of equity accounting. And if I could have a computer which would do that for me faster than me, oh, that's a winner. So digital financial reporting is a winner for the novice financial user, and also the sophisticated who thinks that there are parts of these accounting standards I don't like. Equity accounting, particular lease transactions, if you could just use a computer to just strip them out, it's going to increase the usability of financial reports just so much more, so much faster.
Now, there's a question here from Lindsay. What drives the reluctance of the Australian Treasury to the adoption of digital financial reporting? is there an international imperative, such as avoiding international pariah status, that will force us to adopt it?
That's a really tough question without getting into libel territory, defamation.
Yeah.
I'll be kind here, Lindsay, and I'll say that if there's one impediment, it's probably the fact that it's just who cares from Treasury. If I think of Treasury, financial reporting isn't an issue for them. It doesn't rate. So there's no champion for it. We've got a champion for climate reporting. And so hence why I do worry that we're going to have digital climate reporting before we have digital financial reporting. But the fact that we've had no one advocating for it in Treasury for a decade, 15 years, I think it's just that who cares in Treasury? And I think realistically, the rest of the world actually cares. So I think Treasury's out of touch. And I think this is just another one of those consequences of having our federal government being located outside of a major capital city. Oops, I just said that Canberra wasn't a major capital city. Oops, I meant that.
All right. Okay. That's will we become a pariah state? Lindsay asks.
We'll just go invisible. If you're a major fund, if you're BlackRock, one of the first things that you do when you're searching for investment opportunities around the world, you vacuum data of every available database, like Edgar, like we should have. If that data isn't available, you don't get through the primary screens and you don't go on the investment selection choice. So the risk is that we actually just go dark and people forget about us. And if you don't have that demand for securities, equity, loans, whatever, then you have a higher cost of capital and you have a slowing down of the economy because capital is just too expensive. So I wouldn't call it a pariah status, but what I would say is that you actually run the risk of going invisible,
And so
anonymous.
the productivity commission angle that you're talking about, everyone's talking about productivity. Treasury doesn't see this as adding to productivity.
They should. It's obvious as the nose on my face. It is a productivity issue. If you're invisible to international investors, you will have a higher cost of capital, and that will impede investment and productivity.
Yeah.
It's not an issue for BHP. BHP is the largest resources company in the world. They are already SEC registered. They file on Edgar. So everything about BHP is totally transparent, but they're not the normal Australian company. So the real issue is that it's going to impact not the top 1%, it's going to impact the 99% of companies who don't actually have a global profile. And just to put that into context, the other day, the CEOs of Rio and BHP had a problem in the US. So they had a lunch meeting with Donald Trump. That's how big they are and how on the radar they are. So what we need to understand is that that's not a normal company. They don't have that ability to attract attention. They don't have the information freely available. For normal companies, if you don't have digital reports, the international investors won't find you and you just won't get the capital that you need to survive in the modern age. So pariah status is not quite the right word. What I call it is actually invisibility. Who cares?
Yeah, so it is the need for a political someone with political capital to spend. Look, this Bruce Millthorpe says, thank you for an interesting presentation on a somewhat opaque topic. With adoption of digital financial reporting, should we also see some review of the Australian accounting standards especially around tax-exempt institutions such as universities and shire councils?
Okay, two completely separate issues. On the accounting front, with the accounting standards, we don't have any choice. We've put our money into the International Accounting Standards Board. We follow international financial reporting standards. These are required for Australian corporations, and I would hate to see the differential accounting standards apply to different types of companies. That just becomes really confusing. And if I could use just a personal reflection here, I'm a director of a not-for-profit and turnover $8-9 million. But what I would say is that all the complex accounting standards we have don't apply to us. We don't have employee stock options. We don't have complex financial instruments. We don't have problems with deferred tax because we don't pay tax. We only have the simple accounting standards. So the accounting standards which apply to small companies, it's a bit like an automatic transmission in a car. The complex standards apply to the big corporations, not the small corporations. So accounting standards aren't the problem. And I think what Bruce is sort of confounding here is tax rules, which are separate from accounting rules. And that's what the tax department wants to, and what the government wants to do. If they want to create a tax exempt status, they can do it. That's not a function of accounting standards. That's something different. So in answer to your question, Bruce, I think that accounting standards have to be consistent. I know that around the world, they're not entirely. I know that in Europe, international accounting standards only apply to the largest corporations, whereas we apply them to all corporations. I think we've got the right side of the agenda on that one. But I think that when it comes to other issues like tax deductibility or tax paying or those sorts of issues, that's a government policy issue, not an accounting issue. So I would probably distinguish it in that way. Do you want to have a follow-up question on that one, Bruce?
He's having to speak through the
Moderator,
Q&A,
yeah.
so I'll wait for him to type that in.
Yeah.
The Zoom master says, what's the burden to the lower end of medium-large companies? Does it provide a benefit versus targeting for hostile takeovers and the like?
Look, the cost burden at the end of the day is zero. Sorry, virtually zero. If you're the not-for-profit that I'm associated with, the accountant uses a piece of software which is called Caseware. The accountant probably pays a fee of $5,000 or $6,000 a year to use the software for its clients. If you're going to prepare a digital report, I'm not quite sure. Last time I checked, Caseware couldn't do it, but a Curie could do it. And the cost of their software for an accounting firm license was $7,000. The cost differential, when you allocate it across different clients, is virtually zero. So at the lower end, I think the claims about cost are greatly exaggerated because, to be perfectly honest, at the lower end, all the firms that I've ever seen produce really, really generic software-generated reports. There's no tailoring. There's no anything going on. It's just there. And at the end of the day, a report in one format or the other, they're both generated by computer programs. They both have roughly the same cost. So I don't think there is the cost that people are scared of at the bottom end. And with the initial implementation of digital financial reporting in the US, one of the things was they found that even for US SEC registrants, the cost of implementation or preparing a digital financial report was under 20 grand. And sorry, SE registrants are actually large corporations, not the bottom end that we're talking about. We're talking about companies in
Actually,
the ASX 300.
what Guy said is that he's really more concerned about the risk burden rather than cost.
When you say risk, I think that the risk for me is, I think of risk in terms of financial reporting error. And you've only got to read financial reports to realize that at the bottom end of the market, there is just so much inconsistency in reports. It's a bit like, spot the difference. Watch for the inconsistency between note 7 and note 13 and work out which one you think is right because they're actually inconsistent. Whereas digital financial reporting just lets you run some software through that and go, warning, 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 warning. We have an inconsistency there. So I think that the risk at the bottom end is actually quite low because it actually allows you to get the errors out of financial reports. And what I'd also say at the bottom end is that the benefit is that, and this once again comes back to risk, is that when you have digital financial reporting, you can provide your reports to the bank, and they may be the primary user, and they can immediately upload them, put them through their software package, and prepare a detailed analysis of what's going on in that business. So you've got to think about it for the small firms, not just in terms of the accessibility of the data, but also what's done with that data and doing all those things that you paid first, second, and third year accountants out of university to actually do with that data to actually tell you what was going on. So, and that applies to all firms, especially at the bottom end, and to turn financial reports into what the long-term cash or the 1, 2, 3 year cash flow implications are, I think is quite important. And that's a real benefit for even the small for corporations, because they can actually provide data which is usable to their lenders, and it can be tailored to the lender's requirements really quickly and really cheaply.
Bruce has come back. Yes, I was more thinking about the P&L problem that depreciation and amortization adds to when that line is less applicable to tax-exempt institutions which get capital through grants.
Okay, well, the issue there is that once you move to digital financial reporting, then what can happen is that you can get the software which will say, here's the data, and we'll recast our financial statements automatically into a format where depreciation, amortization is immediately excluded. And it sort of goes back to what I was talking about when I was talking to Guy before and saying that one of the problems with traditional financial reports is they straitjacket how the information is presented. When you move to digital financial reports, you allow the user to determine what they want to see, how they want to see it. So in terms of presenting yourself for grants, you can say, here's a report minus depreciation or minus whatever. So you can very much tailor, and that's one of my criticisms of the existing accounting standards, is that one of the things that they do is they say, this is how you'll read the income statement. And that's something that I've never done. I've always read the statement how I want to read it. I look at asset impairments, and some people say, oh, but these aren't relevant to determining future cash flows. I look at them saying, impairments, that's a reflection of really bad investment decisions in the past. Are they real losses? Yes. So there's an interpretation issue always associated with these things.
If everybody had been going in for your preferred model, would we still have had the collapse in 2008?
Okay. That's a
Would
really
there
good
have been more
question.
transparency, or do you have to be so clever to? I mean, it took forever for people to journalist to say something that I could understand about what had happened in 2008, 2009. Gillian Tett, the FT person, was excellent. But
Okay.
do you have to be very clever to understand what's going on anyway?
How do I answer this question? Okay. Can I say that to understand what was really at the heart of the GFC, which was a liquidity crisis, more than a financial crisis, it was liquidity. You needed to understand the instruments which were at the heart of it.
Indeed.
And one of the, if you, at the risk of self-promotion, if you really want to understand the crux of the GFC, I had a PhD student, and as we all probably in this room know, that PhD students are the last legalized form of slavery. If you look up my publication record, you'll see that I have a paper which was published in an innocuous finance journal, which looked at Countrywide Finance Corporation. Now, no one here has ever heard of Countrywide Finance Corporation. You've heard of Citibank, you've heard of Merrill's,
Yeah.
you've heard of Lehman's, you've heard of all the big guys. But what you don't appreciate is that coming into the mid-80s, Countrywide Finance was the originator of 25% of the mortgages in the United States. Now, how does an innocuous company get to that position? And it was through asset securitization, and it was the way they were structured and the way they were accounted for. Now, if you look at that paper that I wrote with a PhD student, which was looking at the countrywide finance, it was a case study, and it was tabled in Congress in the US, so it's reputable. But the accounting and finance doesn't like case studies. So what that tells you is how the US got themselves into that position. And what I would say is that, is it going to happen? So what you're more concerned about is, could we have avoided it and could it happen again? They changed the accounting standards, and this is where you're getting into the rocket science territory. But one of the things that we used to have with the asset securitizations pre-GFC was that if you think of a loaf of bread, they sliced it that way and they securitized the different layers, and they allowed those to be taken off balance sheet.
Yeah.
Post-GFC, the accounting standard was changed, and if you suffer from insomnia, can I encourage you to read AASB 9, Chapter 3. And what we do now is we require the asset. If you want to use asset securitization, you have to slice your loaf long ways, so you don't end up with the bottom slices of really crap securities, which are problematic to value, because that's what it was. And
yes.
with the vertical slices, the really crap loans are not concentrated, they're separated out. And
okay, well, yeah, that was what it took. People did manage to make that clear in language for non-accountants in the end, but it took a long time.
Yeah, and what it came down to at the end of the day was the GFC was a liquidity crisis because nobody knew, when they were trading between banks, how bad the person they were trading with was. And so it was a crisis of confidence more than a crisis of anything else. So I think I understand how the GFC occurred. It was some pretty shady accounting practices. It was done with pretty dubious understanding of risk and correlated risk, because that was what you got at the bottom end. Is it going to happen again? No, because No asset securitization is done these days with vertical slices, sorry, horizontal slices. It's all done with vertical slices. So they actually understood that, and the regulation's been fixed up to make sure that firms do not go down that path.
Okay, look, I've got one more question. I think this is probably the last one, and it's what difference is artificial intelligence going to make to this whole process? Is it going to make a difference? Could we sort of give up on digital financial reporting and just let Chat GPT do it all for us?
Okay. Easy answer here. Firms using or packaging digital financial data were available before we started talking about AI. So, for example, in the lead up to the transition to the new leasing standard, there were firms which said, okay, we've extracted the digital data. Here's what the financial statement's going to look like post the new accounting standard, and they were pretty accurate. So AI isn't the game changer. Is AI going to be the biggest driver of change? I think not. I think it's going to kill first, second, third, fourth, fifth year analysts because the jobs that they do are going to be done by AI, but it's the more clever and the more sophisticated jobs which will remain. So, and we need to understand that accounting is very much a closed system. And if I could take you back in time, you might remember a number of years ago that Slater and Gordon, it had a particular strategy for expansion. It was acquiring accounting firms. It acquired a big business in the UK. Its stock price was up to $8, and the short sellers hit it. And sorry, the short sellers knew exactly what they were doing. They identified that there was a problem with how they valued their receivables, and it was identified by how they accounted for their acquisitions. They extrapolated that to the business as a whole, and they said, whoa, this financial report is really garbage. And they started short selling at $8. They reevaluated their position at about, or some of them did, sorry. Some of them reevaluated their position at about $3, and they said, no, we're staying on here. And they eventually bought back in at 18 cents. But that was because they took from one area into an unrelated area, insights into what was driving Slater and Gordon accounting and the assumptions which are underpinning what they were doing. Now, is AI able to do that at this stage? No. So what I would say is that AI will get rid of grunt work. Sorry, that's a pretty derogatory term, isn't it? Trainer work, where analysts learn their skills, and there's going to be, if we use AI like this in digital financial reporting, it's going to create a problem in 10 years' time because all the old guys and girls will retire and there's not the next generation. And we've already seen this in the accounting firms the large accounting firms who often outsourced to Bangalore, say 5 years ago. So they required less first and second year auditors. And the upshot of that was they came to year 3 and they went, oh God, we've got no third year auditors.
Yeah.
So that's the conundrum that business has to, in the accounting space, has to manage. And that's balancing the, how will I put it, the need to train and develop the skills for people who can become experts. Whereas in the short term, it could be probably done cheaper by AI. And that's the real conundrum because AI is really good at doing what we know. It's not good at what we don't know and problem solving. So if I could just use one of
So how can you get this political will going? I mean, obviously you've been working at it for a decade more,
Um,
15 years, I think.
can I have it carved on my gravestone? Uh, look, to me, it's just so dead bleeding obvious. I just can't believe that after all this time, we have these Neanderthals down in Canberra who can't actually see that there's a truck coming towards them, and they don't realize that it's going to wipe out their car when it runs into them.
Well, surely, though, it has to be a political. Uh, Treasury does what the politicians want them to, and so it's going to be. I don't know how. Anyway,
I would look, it was recommended by the Parliamentary Committee in 2020. If you read their report, um, you'd see that digital financial reporting was mentioned God knows how many times. One of my colleagues from another university described the report as the Peter Wells interim report because they thought it should be renamed because I was mentioned so many times. But it just disappeared into Treasury and it just got stalled, becalmed. Nothing happened. So it needs a champion in Treasury to actually understand this is important. And being defamatory, does Treasury have the ability to understand that?
well, of course, they're not accountants, are they? They're economists. It's a different thing.
Yes.
I think we probably need to draw this to a close now, Peter. It is a remarkable um, achievement, I think, to make digital financial regulation an exciting topic. It does not, as it were, grab you as to start off with, but you have done that, and you've done it in a way which I think has drawn a lot of connections. And as you know, we've had many sessions over the last 2 years in the Royal Society on productivity, and this part of the puzzle looks like just yet another one of the bits that really is necessary to break that productivity logjam. I wonder whether there's anything about Australia, New Zealand, and Canada that makes us more conservative in financial reporting than other areas. I mean, it's a but it's been such a fascinating talk. And I think, as I say, it's tested me beyond my comfort zone. But I'm really grateful, and as you say, that there is a room for advocacy, but I don't know how to do it. I don't know the space. So, anything more for you to add before we close? Thank you, Peter. Thank you very much, and thank you for being our treasurer. We're
Thank, thank you for everyone coming along tonight. It's probably not what you thought you were going to get. Canada's an interesting one. I think that most of the medium to large Canadians corporation drift across the border,
Yeah.
and so they get captured by the US. Australia and New Zealand, if you're going to ask me, there's no real reason. What I would say is that, is this one area where there should actually be one database for both? Absolutely. It should be a joint venture because are people going to search a database for New Zealand or the Pacific Islands? No. It's, to me, it's not just an Australian issue, it's a Asia Pacific issue. And there are some large companies through the Asia Pacific area, which in countries which we support, PNG, they have some large corporations, Oil Search. Should they be on a digital financial reporting database? Absolutely. They might be caught by the Australian one, who knows? But it's one area where it should be a more of a collective approach. Australia, New Zealand, and countries that we support. So that's the other thing. And I think it's just that for smaller countries, it's just more problematic. And if they have a database, who's going to search it? So therefore, it has to be a combined.
It does have the feeling of what's gone wrong with productivity more generally, and I think that's very interesting. Lack of investment, lack of looking forward. So I think that's been really illuminating, and it's beginning to produce a theme for us. It's now time for me to close the 1334th ordinary general meeting. This is another achievement. It's almost as good as hitting the White House, isn't it? I'm very, very grateful to you, and I'll close the meeting now. Thank you very much.
Thank you, everybody.
Thank you.